Hi everyone, welcome back to Gap Advisors. I'm CA Priyanka Vazirani. This presentation deals with the accounting for loans to employees that do not bear the interest rate reflecting market conditions. The facts of the case are right here on your screens. A company has advanced a housing loan to one of its employees at a concessional rate of interest, which is repayable in 5 equal annual installments payable at each year end. The rate of interest as agreed in the loan agreement is 7% per annum, while the market interest rate is 15% per annum. The employee is not required to give any specific performance against this benefit. The questions are, as the loan is not made on normal commercial terms, how should the difference between loan proceeds and fair value be treated? Should the same be recognized as expense in entirety on initial recognition, or should it be deferred over a certain period of time? What are the implications of the fact that the employee is not required to give any specific performance against this benefit? Will the answer remain the same if the loan is other than housing loan? Will the answer remain the same if the favorable terms on which the loan is granted cease to exist on the termination of employment? The query is under the Ind AS framework, which is company's Indian Accounting Standards Rules 2015 as amended from time to time. The requirements of Ind AS 109, Ind AS 113 and Ind AS 19 will be applicable to this case. We'll go through the next slides to discuss why and how all these requirements will apply. As per Ind AS 32, any asset that is a contractual right to receive cash or another financial asset from another entity is a financial asset. Therefore, this loan meets the definition of a financial asset to which the requirements of Ind AS 109 will apply. Ind AS 109 states that an entity may, at initial recognition, irrevocably designate a financial asset as measured at fair value through profit or loss if doing so eliminates or significantly reduces a measurement or recognition inconsistency that would otherwise arise from measuring assets or liabilities or recognizing the gains and losses on them on different bases. In the absence of information, it is assumed that the company has not designated the loan as subsequently measured at fair value through profit or loss in accordance with paragraph 415 of Ind AS 109. The standard also states that except in case of certain trade receivables, at initial recognition, an entity shall measure a financial asset at its fair value. Therefore, in this case, the company shall measure the loan to employee at fair value. Ind AS 109 states that the fair value of a long-term loan that carries no interest can be measured as the present value of all future cash receipts discounted using the prevailing market rate of interest for a similar instrument with a similar credit rating. Therefore, the entity shall measure the financial asset, that is the loan, at present value of future payments discounted at a market rate of interest for a similar debt instrument as determined at the initial recognition. It is also specified in the standard that if the fair value of the financial asset at initial recognition differs from the transaction price, an entity shall apply paragraph B5(1)(2)(a). As the company has granted the loan to employee at a concessional rate, the transaction price shall differ from the fair value, and therefore the company shall apply paragraph B5(1)(2)(a) of Ind AS 109 to account for this difference. Paragraph B5(1)(2)(a) states that the best evidence of the fair value of a financial instrument at initial recognition is normally the transaction price, that is, the fair value of the consideration given or received. But if an entity determines that the fair value at initial recognition differs from the transaction price, the entity shall account for that instrument at that date at the fair value plus minus transaction costs that are directly attributable to the acquisition or issue of the financial asset, as required by paragraph 511, which we just discussed. But how should the entity account for the difference between the fair value and the transaction price depends on whether the fair value is evidenced by a quoted price in an active market for an identical asset or liability, that is a level 1 input, whether it's based on a valuation technique that uses only data from observable markets. In these two cases, the difference between the fair value at initial recognition and the transaction price shall be recognized as a gain or loss. But in all other cases, the difference should be deferred. And after initial recognition, the entity shall recognize that deferred difference as a gain or loss only to the extent that it arises from a change in factor, including time. Ind AS 109 also requires an entity to measure a financial asset at amortized cost if two conditions are met. The financial asset is held within a business model whose objective is to hold financial assets in order to collect contractual cash flows, and the contractual terms of the financial asset give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. It is very clear from the facts of our case that the terms of the loan to employee give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding. Further, owing to the limited facts available, we will assume that the company does not have the practice of selling loans to employees. That is, loans to employees are held to receive interest and principal cash flows, or you can say the company holds the loan to employee within a business model whose objective is to hold such loans to collect interest and principal cash flows. Therefore, the company shall classify the loan to employee as subsequently measured at amortized cost. To conclude what we just discussed, the company shall measure the loan to employee at fair value initially. Whether the difference between fair value and transaction price or loan proceeds should be recognized in the statement of profit and loss in the very first year, or should it be deferred over the loan tenure, is based on the inputs to the fair value in accordance with paragraph B512A of Ind AS 109. A loan to an employee is not quoted in an active market, and therefore the fair value has no level 1 input. Accordingly, the company shall consider whether the valuation technique uses only data from observable markets. Where the valuation technique uses only data from observable markets, the difference shall be immediately recognized in profit or loss. But where the valuation technique uses data from other than observable markets, the company shall defer the recognition of the difference in profit or loss by recognizing the same as an asset on initial recognition and then amortizing the asset over the period of the loan. Further, in our view, the deferred difference should be recognized in the statement of profit and loss either on a straight line basis or based on the pattern of effective interest over the term of the loan. As per Ind AS 19, employee benefits are all forms of consideration given by an entity in exchange for service rendered by employees or for the termination of employment. In our view, regardless of whether the recognition of this difference in the statement of profit and loss is immediate or deferred over the period of the loan, the company should present this difference in the statement of profit and loss as employee benefit expense, as the loan is not made on normal commercial terms, and therefore the concession in rate is a consideration flowing to the employee for his or her services. Existence of performance condition is not necessary for the difference to be regarded as employee benefit expense. If the loan is not a housing loan, but say a car loan, the only change it could have on our response will be due to change in the market rate of interest, which may differ in any other type or nature of loan. The requirements of Ind AS 109 are the same for all financial assets and are not specific to the nature of the loan. Friends, the terms of the contract could be such that the loan becomes repayable if the employee leaves the company within a certain time period. Or the contract may state that the loan will revert to market rate of interest if the employee leaves within a certain period. One may argue that if the contractual right to the favorable terms of the loan ceases to exist on termination of employment, the benefit has not been fully earned by the employee and is available only while the employee provides its services to the company. And therefore, immediate recognition of the difference in the statement of profit and loss may not be appropriate in such cases. However, it is important to consider the requirements of paragraph B512A, which simply require the difference to be treated based on inputs to the fair value. Let's understand this through an example. Let's think of a case where further service conditions are attached to the loan and the employee must repay the loan in entirety if the employee leaves the organization before 3 years. At the same time, the valuation technique adopted by the company uses only the data from observable markets. In that case, not recognizing the entire difference in the statement of profit and loss in the first year itself or on initial recognition itself will lead to non-compliance with the requirements of paragraph B5(1)(2)(a) of Ind AS 109. Therefore, in our view, our response will not change depending on any change in the terms of the loan due to termination of employment. Having understood it all theoretically, now let's get back to our example. We'll cover the situation where the company would defer the recognition of the difference in profit or loss. This table 1 shows the cash flows flowing to the entity in the form of yearly installments and the present value of those installments at market rate of interest, which is 15% per annum. The present value of 8,242.30 rupees is the amount at which the loan should be recognized in the balance sheet as financial asset, which will accrete to 12,100 rupees over the 5-year period of the loan. 12,100 being the total of all the 5 installments, principal repayments plus interest payments over the tenure of the loan. The difference between the loan proceeds of 10,000 rupees and the amount of 8,242.30 rupees will be treated as prepaid expense and deferred for recognition in the statement of profit and loss. Here the table 2 shows the calculation of interest income for each period based on the fair value of the loan asset and the amortized cost using the effective interest method. Such interest income should be recognized in the statement of profit and loss in each year. If the difference between the fair value and transaction price is to be straight-lined over the period of the loan, the journal entries that will be passed are on your screens. Now, if the company chooses to amortize the difference over the loan tenure based on the pattern of effective interest, we'll calculate the difference between the interest income for each period based on the fair value of the loan asset and the amortized cost using the effective interest method and the actual proceeds of interest at the rate of 7% per annum. Such difference will be recognized as employee benefits expense each year. Here are the journal entries to be passed in the second scenario. Friends, hope this case study did some value add to your conceptual understanding of the accounting of concessionary loans to employees under Ind AS. If you have a contradicting view on any aspect, we'll request you to post it as a comment so that other viewers can benefit from the same by understanding different perspectives and make informed judgment on which view is appropriate. Please subscribe to Gap Advisors for more such videos and don't forget to hit the bell icon which will notify you of any new videos as they are uploaded. Thank you. Happy learning.